Hi everyone, I'm Allison Smith and I did my research on the Domestic Production Activities Deduction, so that's IRC Code Section 199. So throughout this presentation, a common acronym used for the Domestic Production Activities Deduction is DPAD, and I'll also refer to it as Section 199 or Section 199 deduction. So this is a pretty common deduction taken by both small and large businesses filing U.S. income tax returns. The reason why it's usually businesses filing U.S. income tax returns is because this deduction is mainly targeted to U.S. manufacturers and other industries in order to bolster U.S. competition internationally. So I figured the best place to start is kind of an overview of the code section. So it's on the screen, but the allowance of the deduction, there shall be allowed as a deduction an amount equal to 9%. So that's the current deduction percentage of the lesser of the qualified production activities income or taxable income determined without regard to this section. So you can't take into account this deduction. Sort of like a circular thing, which makes it complex to calculate, but that's mentioned later also. So it's limited to taxable income, but it's generally your qualified production activities income. So as defined, your qualified production activities income in the code for purposes of this section are your domestic production gross receipts for the year over the sum of cost of goods sold allocable to those receipts and other expenses, losses, or deduction other than this deduction, which are properly allocable to such receipts. So essentially it's saying that your qualified production activities income is essentially your net income related to your domestic production gross receipts. So domestic production gross receipts being essentially anything domestically that qualifies as an industry as production. So the code says any lease, rental, license, sale, exchange, or other disposition of qualifying production property which was manufactured, produced, grown, or extracted in whole or in significant part within the U.S. It also includes any qualified film produced, electricity, natural gas, potable water, as long as it's in the U.S., construction, engineering, architectural. So as you can see, it's not just manufacturing. There's actually a fair amount of industries that are included in this, but it was mainly targeted for manufacturing. So the deduction is also limited to wages paid. The amount of deduction allowable under subsection A for any taxable year shall not exceed 50% of the W-2 wages for that year. So W-2 wages for purposes of this section essentially just also need to be related to the domestic production gross receipts. So we kind of just went through it, but essentially the process of calculating it in less complex terms than the code section is to determine what part of your net income is a qualified production activity and relates to U.S. business activity, and then that's determined on an entity-by-entity basis, and then it's multiplied by 9%, and it just needs to be limited by taxable income or W-2 wages. So in terms of a history of Section 199, around 2004, or maybe a little earlier since that's when it was enacted, Congress started becoming concerned that U.S. manufacturing was falling second to U.S. imported goods, and domestic prices here in the U.S. started becoming undercut by foreign businesses, and foreign countries were beginning to reap all of the benefits. So it was enacted in 2004. It kind of has a shorter history in the grander scale of the IRC, but it was enacted for relief from the negative impacts of the prices being undercut as part of the American Jobs Creation Act by President Bush. So this new law, as a part of the American Jobs Creation Act, did two things. It actually flip-flopped in and out. It repealed previous extraterritorial income provisions, so the ETI provisions, and then replaced that with Section 199. So the ETI provisions previously provided a tax break by allowing certain export income and limited foreign operation income to be exempt from U.S. tax. So this is a quote that I just thought was important. It's directly from a Joint Committee on Taxation report that essentially clarified the tax law that was put forth in 2004. So this just kind of lays out the original intent. So the Congress believed that creating new jobs is an essential element of economic recovery and expansion, and that tax policies designed to foster economic strength will also contribute to the continuation of the recent increases in employment levels. So to accomplish this objective, the increase in employment levels, the Congress believed that it should enact tax laws that enhance the ability of domestic business and domestic manufacturing firms in particular to compete in the global marketplace. So, as outlined in that quote that I read from the Joint Committee on Taxation report, as part of the American Jobs Creation Act, the main goal was to create more jobs. So this was to be done through supporting domestic manufacturing and other industries, and in turn also reducing effective corporate tax rates for industries that are qualified for the deduction. So the hope is that these companies would prosper and do well and hire more people. So the Joint Committee on Taxation report also says that in order to create new jobs, Congress must reduce the tax burden on domestic manufacturers. So this deduction would hopefully reduce that burden, and they would in turn hire more people. Another important thing to know is that companies don't have to be 100% domestic either. They can take the deduction against any qualified domestic income. So it can be 20%, it can be, whatever percentage or whatever activities that they have in the US, which kind of just contributes to the complexity of the calculation, but it does make the deduction allowable to a lot more companies. So there have been some law changes with Section 199 throughout the years, throughout the past 10 to 11 years. So the first one is the deduction percentage. So when I read the IRC Section 199 directly from the code, it said that it was multiplied by 9%. So when this was enacted in 2004, though, the deduction was originally set at 3% and was phased to 6% in 2008 with the passing of the Emergency Economic Stabilization Act applicable to tax years 2007 through 2009. And then it was scheduled to increase to 9% thereafter, mainly to stimulate the economy at that time. Obviously, we were in a little bit of a downturn, and to combat that. So another tax law change is the definition of qualified production activities. So what qualifies as a production for the purposes of this deduction. So kind of a common misconception with this deduction is that it only applies to manufacturing activities. I've mentioned it a couple times so far, but when enacted, it was outlined that any income earned through production or property that is either manufactured or produced, grown, extracted domestically is eligible. And then, like I said, other industries such as electricity, natural gas, and potable water, just to name a few of them, were also eligible for the domestic production activities deduction. But over the years, kind of production has changed. Activities have been clarified to be included or excluded or limited. So for example, as part of the Emergency Economic Stabilization Act, the deduction was increased in 2008. So that's the original one I just mentioned. That's how it was increased. A part of that also was qualified oil-related income and industries related were limited to a deduction of 6% rather. There have been some proposals of change to this code section. One is the Obama administration. The Joint Committee on Taxation released a report in 2012 that contained the president's proposed changes related to revenue provisions, including changes to the DPAD. So President Obama proposed to eliminate certain non-manufacturing industries such as oil and gas and coal and other hard mineral fossil fuels from the inclusion as qualified domestic production activity, and use that additional revenue to increase the general DPAD rate for only advanced technology manufacturers to 18%. So the goal of this being to eliminate uneven investment distortions between certain business sectors and redirect the benefits to a more narrow group to create more jobs and more development in that specific industry. Other similar proposals have been made by the 110th, 111th, and 112th Congress, who voted to disallow the deduction for the same industries. And there's also been many proposals to just remove Section 199 completely by the Fiscal Commission, the Debt Reduction Task Force, and the Gang of Six, as well as many economists. The reason for the proposal to remove it completely is similar to the Obama administration, just that investment distortions between all sectors of the economy are uneven, and that should be fixed. So, impact of this tax policy implications. When enacted, the estimated revenue loss over 10 years associated with Section 199 was more than 1.5 times the revenue gained from repealing the ETI provisions, as you can see here in this chart. You can see that the revenue losses related to domestic production activities deduction alone were estimated to hit $76 billion. So this provision was estimated to be pretty costly, but it was still passed into law in order to create more jobs and encourage domestic competitiveness with the rest of the world. However, if we look at the next chart, we can see that since 2004, the percent of the population employed has only decreased a full 3% from 62.3 to 59.3 in 2015. This is a chart only domestically. However, if we take a look at our country compared to the rest of the world, we can see the same results. So unemployment rates in the United States just in the United States alone, while low compared to the rest of the countries, and under 10%, have doubled from 4% to 8% in 2012. So lastly, it's important to look at manufacturing specific, since that's what this code was targeted for. And while Section 199 is allowed deduction for a variety of industries, 66% of the benefits of this code section in 2008 went to manufacturing companies. So it's important we look at this. And if we look at this also, we can still see the same trend. So employment in the manufacturing sector has decreased since the enactment of Section 199 in 2004. So after all of this, if we take a look at whether this tax policy has been a success or not, and if we look solely at the original and main intent of creating jobs, we can see a clear failure based on the fact that domestic jobs have been decreasing and unemployment has been increasing. So there's our big fail on Section 199. In terms of my position was fail, and in terms of suggestions for change, one, the calculation of this deduction is complex and causes an administrative burden for both the taxpayer and the government. So costs must be allocated specifically to activities as well as domestically versus internationally, and sometimes causes taxpayers to forego the calculation altogether in taking the deduction. So while this might not solve the issue of Section 199 not achieving its original goal, it would definitely help. Another suggestion of change would simply be to repeal this provision altogether, as mentioned earlier. The added revenues generated by repealing this deduction could make room for a more broad tax rate deduction for industries across the board rather than a few targeted industries. In conclusion, Section 199, mainly enacted to create jobs, bolster domestic competitiveness, reduce effective tax rates, targeted towards manufacturing industry but applied to other industries. The deduction percentage has increased over the years from 3 to 6 to 9, while some industries are still limited to 6. The Obama administration has proposed multiple times retargeting and increasing the deduction for the technology manufacturing industry specifically, while other groups and economists propose repealing the deduction altogether. Since the enactment of Section 199 in 2004, unemployment rates have only increased both domestically, internationally, and also specifically just in the manufacturing sector. So the provision of the tax code, I would say, should be repealed to maybe create room for something more effective, such as a broad tax rate reduction. And here are my sources for the presentation. Thanks for watching.